Beloved seekers of financial wisdom, dear family of builders and dreamers, there's a storm coming. Most people can't see it yet. They're walking toward the edge confident, unaware that the ground beneath them is crumbling. By 2026, millions will wake up to find their wealth has vanished. Not because of bad luck, not because of circumstances beyond their control, but because they made 5 predictable, avoidable mistakes. THEILOCIONOF let me tell you something that will make you uncomfortable. Right now, at this very moment, you might be destroying your financial future without even knowing it. You think you're being careful. You think you're being smart. You think you're protecting yourself, but you're not. You're making the same mistakes that have destroyed wealth for generations. The same mistakes I've watched claim fortunes. The same mistakes that separate those who thrive from those who merely survive. And the tragedy is these mistakes are completely preventable. If you know what to look for, if you're willing to face the truth, if you can change course before it's too late. So let me take you on a journey through the 5 investment mistakes that will absolutely destroy your wealth by 2026 if you don't correct them immediately. And I'm not going to sugarcoat this. I'm not going to make you feel comfortable, because comfort is what got you into this position, and only truth can get you out. Mistake number 1, keeping too much cash. Right now, millions of Americans are sitting on mountains of cash. They think they're being prudent, conservative, safe. They're actually being destroyed. Let me tell you about a woman I knew, intelligent woman, successful career. She had saved diligently for 30 years, had nearly $500,000 in savings accounts and money market funds. She felt secure. She felt smart. She was earning a tiny bit of interest, barely anything, but she told herself it was safe. Then inflation hit. Real inflation. The kind that doesn't just nibble at your wealth but devours it. In just 3 years, her purchasing power dropped by over 20%. That $500,000 could now buy what $400,000 used to buy. She hadn't spent a penny, but she lost $100,000 anyway. That's the cash trap. It feels safe because the number in your account doesn't go down, but the value of that number is evaporating like water in the desert sun. And here's what terrifies me, it's getting worse. Central banks have printed more money in the last few years than in the entire previous century combined. That money is flooding the system, chasing goods, driving up prices. Your cash is losing value faster than you can imagine. Every month you hold it in savings, you're getting poorer, not richer. Poorer. I know what you're thinking. But what about market crashes? What if I invest and the market drops? A valid question. Wrong conclusion. Yes, markets fluctuate. Yes, there will be corrections. There always are. But over time, invested money grows. Cash loses. It's that simple. If you keep too much in cash, you're not avoiding risk. You're guaranteeing loss. So here's what you need to understand. Cash is for emergencies and short-term needs only. 3 to 6 months of expenses. That's it. Everything else should be working for you, not sitting idle, slowly dying. But here's where people make it worse. They don't just keep too much cash. They keep it in the wrong places. Traditional savings accounts paying 0.5% while inflation runs at 4% or 6% or higher. That's not saving. That's financial suicide. If you're going to hold cash for emergencies, at least put it in high-yield savings accounts or treasury bills that keep pace with inflation. Don't just hand your wealth over to inflation without a fight. But the real solution is this: stop thinking of cash as an investment. It's not. It's a tool. A temporary parking place for money that's about to be deployed elsewhere. The investors who thrive, the ones who build real wealth, they keep minimal cash and maximum investments. They understand that time in the market beats timing the market every single time. By 2026, the people sitting on piles of cash are going to wake up to a brutal reality. Their wealth has been systematically destroyed, and there's no getting it back. Don't be one of them. Mistake number 2. Chasing hot trends. I've been investing for over 70 years, and in that time I've watched the same pattern repeat endlessly. A new trend emerges. Everyone gets excited. Money floods in, prices skyrocket. People think they've found the secret to easy wealth, and then it collapses every single time. In the late 1990s, it was dot-com stocks, companies with no earnings, no business model, trading at absurd valuations. People mortgaged their homes to buy them, because everyone said this time was different. The old rules didn't apply. They were wrong. Trillions of dollars evaporated. In 2008, it was subprime mortgages and over-leveraged real estate. Everyone thought housing prices only went up, that it was impossible to lose money in real estate. They were wrong. Millions lost everything. And now, right now, there are multiple bubbles forming. Cryptocurrencies trading on pure speculation. Meme stocks driven by social media hype. SPAs with no real business behind them. AI companies valued at billions despite never turning a profit. History doesn't repeat, but it rhymes. And this rhyme is getting loud. The mistake people make is this: they confuse a trend with an investment. They see prices rising and assume it will continue forever. They abandon fundamental analysis in favor of momentum. They buy because something is going up, not because it's worth what they're paying. Let me be crystal clear: when you invest in something you don't understand, based on nothing more than price momentum and hype, you're not investing. You're gambling. And the house always wins in the end. I've seen brilliant people with PhDs and successful careers, lose fortunes chasing the latest trend, not because they were stupid, but because they got caught up in the emotion. The fear of missing out, the belief that everyone else was getting rich and they were being left behind. FOMO, fear of missing out. It's one of the most expensive emotions in investing. Here's the truth nobody wants to hear. If something sounds too good to be true, it is. If everyone is talking about an investment opportunity, you're already too late. If you don't understand how something creates value, you shouldn't invest in it. But people don't want to hear that. They want to believe in shortcuts, in easy money, in the idea that they can get rich quick without doing the hard work of real investing. So they pour money into whatever is hot. Crypto, NFTs, whatever the internet is buzzing about this week. And by 2026, when reality reasserts itself, when gravity returns to financial markets, they're going to lose everything. I've met people who turned $100,000 into $10,000 by chasing trends. People who could have retired comfortably if they just invested in boring, simple, proven strategies. But they got greedy. They got impatient. They got swept up in the hype. And they paid the price. Here's what you need to do instead. Invest in things you understand. Businesses that create real value. Assets with proven track records. Strategies that have worked for decades. Is it boring? Yes. Will your friends be impressed? Probably not. Will you have exciting stories at dinner parties? Definitely not. But will you build lasting wealth? Absolutely. Because real investing isn't about excitement. It's about returns. And the most reliable returns come from the most boring investments. Broad market index funds, quality dividend-paying stocks, real estate in growing markets, bonds for stability. These aren't sexy. They won't make you feel like a financial genius, but they work. They've worked for a century. They'll work for the next century. The key is this: stop trying to beat the market. Start trying to match the market. Because matching the market consistently over decades makes you wealthy. Trying to beat the market, chasing the next big thing, usually makes you broke. By 2026, there will be two groups of investors: those who stayed disciplined and focused on fundamentals, and those who chased trends and got destroyed. Which group will you be in? A mistake number 3, ignoring taxes. This one makes me angry. Not at you, at the system, at how little financial education people receive about taxes, and how devastating that ignorance can be. Taxes are probably the single largest expense you'll pay over your lifetime. Larger than your house. Larger than your cars, larger than everything else combined, and most people have no strategy for minimizing them. They just pay whatever they're told to pay, year after year, decade after decade, hemorrhaging wealth that could have been protected with basic planning. Let me give you an example. 2 people, same income, same investment returns, but one understands tax strategy and one doesn't. Person A invests in taxable accounts, trades frequently, generates short-term capital gains taxed at ordinary income rates, doesn't max out retirement accounts, doesn't understand tax loss harvesting. Person B invests in tax-advantaged accounts first, holds investments for long-term gains, maximizes 401k and IRA contributions, uses tax loss harvesting to offset gains, understands Roth conversions. Over 30 years, same income, same returns. Person B ends up with 40% more wealth than person A, 40%. Not because they earned more. Not because they invested better, simply because they kept more of what they earned. That's the tax advantage. And it's massive. But here's what's coming that should terrify you: tax rates are going up. They have to. Government debt is exploding. Social programs are expanding. The bill is coming due. And if you're not prepared, if you don't have a tax strategy in place, you're going to be crushed. By 2026, the tax landscape could look very different. Capital gains rates could be higher. Income tax brackets could be higher. Estate taxes could be restructured. And if you haven't positioned your wealth properly, you could lose a massive portion of it to taxes that were completely avoidable. So what do? Here's the framework for first, max out every tax-advantaged account available to you. 401k or ASA. These accounts let your money grow tax-deferred or tax-free. That's a gift from the government. Take it. Second, understand the difference between short-term and long-term capital gains. Short-term gains are taxed as ordinary income. Long-term gains are taxed at lower rates. If you're trading frequently, you're paying the highest possible taxes on your gains. Hold your investments. Let them qualify for long-term treatment. The tax savings alone can boost your returns by several percentage points annually. Third, use tax loss harvesting. If you have investments that are down, sell them strategically to offset gains elsewhere. This isn't about timing the market. It's about managing your tax liability intelligently. Fourth, consider Roth conversions during low-income years. Pay taxes now at lower rates to enjoy tax-free growth and withdrawals later. This strategy alone can save hundreds of thousands in taxes over a lifetime. Fifth, think about location. If you're in a high-tax state and you have flexibility, consider relocating to a state with no income tax. I know people who've saved millions over their careers simply by moving from California to Texas or Florida. I'm not saying break the law. I'm not saying evade taxes. I'm saying plan intelligently. Use every legal tool available to keep more of what you earn, because every dollar you save in taxes is a dollar that can compound for decades. And over time, those saved dollars become tens or hundreds of thousands of additional wealth. The difference between wealthy people and broke people often isn't how much they make. It's how much they keep. And taxes are the biggest leak in most people's wealth building bucket. Fix the leak. Learn the strategies. Work with a tax professional who understands wealth building, not just compliance. Because by 2026, when tax rates have likely increased and opportunities have been closed, you'll wish you had acted today. Mistake number 4, trying to time the market. This might be the most seductive mistake of all, because it feels intelligent. It feels like you're being strategic, like you're outsmarting the system. You're not. I've been watching people try to time the market for 70 years, and I can count on one hand the number who've succeeded consistently. Everyone else, they've destroyed their wealth trying. Here's how it usually goes: the market is climbing. You're nervous. It feels too high. You think a crash is coming, so you sell. You move to cash. You wait for the drop. But the market keeps going up, 10%, 20%. You're watching from the sidelines, feeling foolish, watching your opportunity cost accumulate. Finally, the market does drop. You feel vindicated. You were right. Now you'll buy back in at the bottom. But when the market is dropping, it's terrifying. The news is apocalyptic. Everyone is panicking. And you freeze. You wait for it to drop more, for the real bottom. But you never catch the bottom. By the time you feel comfortable buying again, the market has already recovered most of its losses. So you've sold high and bought higher. The opposite of what you intended. This pattern repeats endlessly, and every time investors lose. Not because the strategy is wrong in theory, but because humans are emotional creatures, and emotions destroy investment returns. The data on this is overwhelming. Studies consistently show that investors who try to time the market earn far less than those who simply stay invested. The average investor underperforms the market by several percentage points annually, almost entirely due to poorly timed buying and selling. And here's what makes it worse. You only have to miss a few of the best days in the market to destroy your returns. If you invested in the S&P 500 from 1994 to 2024 and stayed fully invested, you'd have earned about 10% annually. But if you missed just the 10 best days over those 30 years, your return drops to around 5%. Miss the 20 best days, and you barely break even. Think about that. 30 years of investing, over 7,000 trading days. Miss 20 of them, just 20, and you've essentially wasted 3 decades. And nobody can predict which days those will be. They usually come during periods of extreme volatility, during crashes, when everything feels hopeless. That's when you need to be invested. But that's exactly when market timers pull out. So they miss the recovery. They miss the best gains. They lock in losses and miss gains. And their wealth gets destroyed. I'm telling you this as someone who's lived through dozens of market crashes. Who's seen every conceivable type of volatility. Who's watched brilliant people try every strategy imaginable. The winners, the ones who built lasting wealth. They did one simple thing. They stayed invested through everything. They didn't panic in 2008 when the market dropped 50%. They didn't sell in March 2020 when COVID crashed markets. They didn't try to outsmart the system. They just held on, kept contributing, kept buying through the crashes, and came out far wealthier on the other side. Because here's the ultimate truth about markets: they always recover. Always. Every crash in history has been followed by new highs. Every panic has eventually given way to prosperity. But only for those who stayed invested. The market timers. They're perpetually buying high and selling low, perpetually missing the recovery, perpetually destroying their wealth while convincing themselves they're being smart. By 2026, there will be another correction. There always is. Markets don't go straight up forever. And when it comes, millions of people will panic. They'll sell. They'll move to cash. They'll try to wait it out. And they'll lose. Again, don't be one of them. Make a plan, invest consistently, and then do the hardest thing in investing: nothing. Just hold on. Through the ups and downs, through the fear and the euphoria, through the crashes and the recoveries. Because time in the market beats timing the market. Every single time. Mistake number 5. Not having a plan. This is the mistake that enables all the others. Because without a plan, you're just reacting to news, to emotions, to whatever financial guru is shouting the loudest that week. And reacting and investing is how you destroy wealth. I've met so many people over the years who were smart, hardworking, disciplined in other areas of their lives, but complete disasters with their investments. Why? Because they had no plan. They'd hear about a hot stock and buy it. They'd read about a crash and sell everything. They'd see their neighbor buying crypto and feel compelled to do the same. They were like leaves blown by the wind. No direction, no strategy, no framework for making decisions. And they got destroyed. Because investing without a plan is like sailing without a compass. You might catch some favorable winds occasionally, but you'll never reach your destination. You'll just drift, lost, until you run out of resources. A plan gives you direction. It gives you rules to follow when emotions are screaming at you. It gives you a framework for making rational decisions in irrational times. So what does a plan look like? Let me break it down simply. First, define your goals. Not vague wishes, specific, measurable objectives. Retire by 60 with $2 million. Pay for your children's education. Buy a home in 5 years. Whatever matters to you, write it down. Make it concrete. Second, determine your timeline, because time horizon dictates strategy. Money you need in 2 years should not be invested the same way as money you won't need for 30 years. Short-term money needs safety. Long-term money needs growth. Third, understand your risk tolerance. Not what you think your risk tolerance is, what it actually is. Because when markets drop 30% and everyone is panicking, you'll discover your real risk tolerance. Be honest with yourself. Build a portfolio you can stick with through volatility. Fourth, create an asset allocation strategy. How much in stocks versus bonds versus real estate versus cash? This is the single most important decision you'll make. More important than which specific stocks you buy. Because asset allocation determines the vast majority of your returns and risk. Fifth, decide on a rebalancing schedule. Markets move. Your allocation drifts. You need a systematic way to bring it back to target. Not emotionally. Not based on market timing. Just mechanically once or twice a year. Sixth, automate everything you can. Automatic contributions. Automatic rebalancing. Remove emotion from the equation. Make good investing behaviors automatic so you don't have to rely on willpower. And finally, commit to reviewing and adjusting your plan annually. Life changes. Goals change, markets change. Your plan should evolve, but slowly, thoughtfully, not reactively. That's a plan. Simple but powerful. And the people who have plans and stick to them massively outperform those who don't. Because a plan protects you from yourself, from your emotions, from the endless noise trying to get you to abandon your strategy. When everyone is panicking and selling, your plan says hold. When everyone is euphoric and buying, your plan says rebalance. When markets crash, your plan says this is temporary. Stay the course. Without a plan, you're vulnerable to every fear, every temptation, every piece of bad advice. With a plan, you have a North Star, something to guide you through the chaos. And by 2026, when markets have gone through another cycle of euphoria and panic, the people with plans will have stayed the course. They'll have continued investing through the volatility. They'll have maintained their strategy. And they'll be far wealthier than those who reacted emotionally to every twist and turn. So if you take nothing else from this, take this, create a plan today. Not tomorrow, not next week, today. Write down your goals, determine your strategy, commit to it, and then stick to it through everything that's coming. Because the next few years are going to test every investor. There will be volatility. There will be uncertainty. There will be moments of fear. And only those with plans will survive with their wealth intact. T. Page Farduerd. Now you know the 5 mistakes. You've seen how they destroy wealth. You understand the traps that claim millions of investors every single year. But knowledge without action is worthless. Understanding without implementation changes nothing. So the question becomes, what do you do now? How do you actually protect yourself? How do you build wealth instead of destroying it? Let me give you the framework. The blueprint, the exact strategy that has worked for generations and will continue working long after I'm gone. This isn't theory. This isn't speculation. This is proven, time-tested wisdom distilled into actionable steps. The foundation: build your emergency reserve first. Before you invest a single dollar, before you think about markets or returns or any of it, you need a foundation, a safety net, cash reserves that protect you from having to sell investments at the worst possible time. This is not about keeping too much cash, which we already discussed destroys wealth. This is about keeping exactly enough cash to handle life's inevitable emergencies without derailing your investment strategy. 3 to 6 months of essential expenses. That's the target. If you lose your job, if your car breaks down, if medical bills arrive, you have breathing room. You don't have to panic. You don't have to liquidate investments. This reserve sits in a high yield savings account or money market fund, somewhere liquid, somewhere safe, earning at least enough to keep pace with inflation if possible. And here's the psychological benefit nobody talks about. When you have this cushion, you can invest more aggressively with everything else, because you know that if something goes wrong, you're covered. You won't be forced to sell stocks during a crash to pay your rent. This foundation changes everything. It transforms you from a reactive investor to a strategic one, from someone who panics during downturns to someone who stays calm and even buys more. Build this first, before anything else. It's the difference between surviving the storms and getting washed away. Step 2. Maximize tax advantage space. Remember what we said about taxes destroying wealth. Here's how you fight back. Every year you have opportunities to shelter money from taxes. 401k contributions, IRA contributions, HSA contributions if you're eligible. These are gifts. Legal ways to reduce your current taxes while building wealth for the future. Max them out. Every single year. This is non-negotiable if you're serious about building wealth. I know what you're thinking. I can't afford to put away that much. But here's the truth: you can't afford not to. Every dollar you put into these accounts reduces your taxable income today. That's an immediate return. Then that money grows tax-deferred or tax-free for decades. That's compound growth without the drag of annual taxes eating into your returns. The difference over 30 or 40 years is staggering. Millions of dollars difference for many people, simply because they use the tools available instead of ignoring them. And if your employer offers a 401k match, contributing at least enough to get the full match is mandatory. That's free money. An instant 100% return. You'd never find that in any investment. Take it. For younger people, consider Roth accounts. You pay taxes now while you're in a lower bracket, then enjoy tax-free growth and withdrawals forever. For older people in high brackets, traditional accounts that defer taxes might make more sense. The specifics depend on your situation, but the principle is universal. Use every tax-advantaged account available to you. Fill them completely before investing in taxable accounts. This one strategy alone can increase your lifetime wealth by 30 to 50%, just by being smart about where you put your money. Step 3, build a simple, diversified portfolio. Now we get to actual investing. And here's where most people make it too complicated. They think they need to pick winning stocks. They think they need to outsmart professional investors. They think wealth comes from being clever. It doesn't. Wealth comes from being consistent and diversified. Here's the portfolio that has worked for decades and will continue working: a mix of low-cost index funds that give you exposure to the entire market. For most people, something like 60 to 70% in a total stock market index fund, 20 to 30% in a total bond market index fund, and maybe 10% in international stocks is plenty. That's it. 3 funds. Broad diversification across thousands of companies. Minimal fees. Simple to maintain. Is it exciting? No. Will you have impressive stories about the stocks you picked? No. Will you beat 90% of professional investors over the long term? Yes, because professional investors have fees. They make emotional decisions. They try to time markets. They chase performance. And they usually underperform simple index strategies over time. You don't need to beat them. You just need to match the market. And matching the market through low-cost index funds makes you wealthy over time. Now, your exact allocation depends on your age and risk tolerance. Younger people can afford more stocks because they have time to ride out volatility. Older people need more bonds for stability because they're closer to needing the money. A simple rule: your age in bonds. If you're 30, maybe 30% bonds and 70% stocks. If you're 60, maybe 60% bonds and 40% stocks. But don't overthink this. The exact percentages matter far less than actually investing consistently and staying the course. And whatever you do, keep costs low. Every percentage point you pay in fees is a percentage point that can't compound for you. Over decades, high fees can cost you hundreds of thousands of dollars. Index funds typically charge 0.03% to 20% annually. Actively managed funds often charge 1% or more. That difference, compounded over 30 years, is devastating. Keep it cheap, keep it diversified, and let time do the heavy lifting. Step 4, invest consistently, regardless of market conditions. This is where discipline separates winners from losers. Anyone can invest when markets are climbing and everything feels great. The real test comes during crashes. Here's what you need to do: set up automatic contributions. Every month, same amount, same day, into your investment accounts, and then forget about it. Don't look at the news. Don't check your balance daily. Don't try to pause contributions when markets feel scary. Just keep investing through the ups, through the downs, through the crashes and the recoveries. This strategy is called dollar cost averaging. You're buying more shares when prices are low and fewer when prices are high. Over time, you're getting a better average price than if you tried to time purchases. But the real power isn't mathematical. It's psychological. By automating, you remove emotion. You're not making a decision every month about whether market conditions are right. You're just executing a plan. And that consistency, that relentless mechanical consistency, is what builds wealth. I've watched people get rich slowly through nothing more than consistent investing over decades. They weren't geniuses. They didn't have inside information. They just showed up month after month, year after year, and kept buying. And compound interest did the rest. By 2026, markets will have gone through more volatility. There will be scary headlines. There will be moments when investing feels foolish. Those moments are exactly when you need to keep investing. Because those are the moments when you're buying at discount prices, when you're setting yourself up for massive gains during the recovery. But most people do the opposite. They stop investing when things get scary. They wait for certainty. And by the time they feel comfortable again, prices have already recovered. Don't make that mistake. Automate your investing, and then trust the process. Step 5. Rebalance annually, not emotionally. Over time, your portfolio will drift. If stocks have a great year, they'll become a larger percentage of your portfolio than intended. If bonds outperform, the opposite happens. This drift changes your risk profile. It moves you away from your target allocation, and it needs to be corrected. But not emotionally, not based on market predictions. Mechanically, once or twice a year, rebalancing forces you to sell what's done well and buy what's lagged. It feels wrong. It feels like you're selling winners and buying losers. But that's exactly the point. You're taking profits from what's run up and deploying them into what's relatively cheap. It's a disciplined way to buy low and sell high without trying to predict markets. Set a calendar reminder. Every year on your birthday, or every January, review your allocation. If anything has drifted more than 5% from target, rebalance back. Sell some of what's high. Buy some of what's low. Return to your target allocation. This simple practice keeps your risk in check and systematically forces you into good investment behavior. And over decades, it adds measurably to your returns. Step 6, ignore the noisy. This might be the hardest part, because everywhere you look, someone is trying to get your attention. Financial news channels shouting about crashes and rallies. Social media influencers promoting the next hot stock. Friends telling you about their latest winning investment. All of it is noise. Destructive, wealth-destroying noise. The financial media makes money from your attention, not from your success. They need you scared or excited because that keeps you watching. Calm, patient investing makes terrible television. So they hype everything. They make every market movement seem critical. They interview experts who make confident predictions that are wrong more often than right. And if you listen to them, if you let them influence your decisions, you'll make mistake after mistake. The solution is simple: turn it off. Stop watching financial news. Stop reading market predictions. Stop following investment gurus on social media. You have a plan, you're executing it. The daily noise is irrelevant to your long-term success. Check your accounts once a quarter if you must. Rebalance once a year, but otherwise live your life. Focus on what you can control: your career, your skills, your relationships, your health. The market will do what it does. Your job is to stay invested and stay patient. Everything else is distraction. By 2026, there will be 100 new crises, 100 new opportunities, 100 new reasons to abandon your plan. Ignore them all. The investors who succeed are the ones who can tune out the noise and stick with their strategy through everything. Step 7. Increase contributions over time. As your income grows over the years, your investment rate should grow with it. This is how you accelerate wealth building without sacrificing your lifestyle. Every raise you get, increase your investment contributions by half of it. If you get a 4% raise, increase your savings rate by 2%. You still get to enjoy 2% more spending, but you're also turbocharging your wealth building. This strategy prevents lifestyle inflation from eating all your income gains. It ensures that as you earn more, you're also building more. And because it happens gradually, you barely notice it. Your lifestyle still improves year over year, but your savings rate climbs from maybe 10% to 15% to 20% and beyond. By the time you're in your peak earning years, you could be saving 30 or 40% of your income while still living very comfortably. That acceleration makes an enormous difference in how quickly you reach financial independence. The difference between retiring at 65 and retiring at 55, between comfortable and wealthy. So commit now. Every future raise gets split. Half to lifestyle, half to investments. No exceptions. Your future self will thank you beyond measure. The reality check: what this means for 2026. Let's bring this back to where we started. By 2026, probably sooner, there will be another market event. Maybe a correction. Maybe a crash. Maybe just elevated volatility. It's coming. I can't tell you when exactly. Nobody can. But it's as certain as winter following fall. When it arrives, millions of investors will make the 5 mistakes we discussed. They'll panic and move to cash, destroying wealth through taxes and missed recoveries. They'll chase whatever new trend promises safety or quick gains. They'll try to time the market, buying high and selling low. They'll forget about tax strategy in their panic. They'll abandon their plans or realize they never had one. And they'll lose badly. But you are not going to be one of them, because you know better now. You understand the mistakes. You have a framework. You have a plan. When markets crash and everyone is panicking, you're going to do something radical. You're going to keep investing. You're going to stick with your allocation. You're going to view the crash as a sale on assets you're accumulating for the long term. You're going to remember that every crash in history has been followed by recovery and new highs. That the investors who stayed calm and stayed invested made fortunes. That panic is expensive and patience is profitable. And in 2030, when you look back at 2026, you're going to realize something profound. That crisis, that moment when everyone else was losing their minds and their money, was when you built the foundation of real wealth. Not because you were smarter, not because you were luckier, but because you were prepared. because you knew what mistakes to avoid, because you had a plan and you stuck to it. That's the difference between those who build lasting wealth and those who don't. Not intelligence, not income, just discipline, patience, and the wisdom to avoid predictable mistakes. The investment mindset you need right now. Let me leave you with something crucial, something that ties all of this together. Investing isn't really about money. It's about psychology. It's about becoming the kind of person who can delay gratification, who can ignore the crowd, who can stay rational when everyone else is emotional. The mistakes we discussed, they're not really financial mistakes. They're psychological weaknesses that manifest in financial decisions. Keeping too much cash is about fear. Chasing trends is about greed and insecurity. Ignoring taxes is about denial and laziness. Trying to time markets is about ego and the illusion of control. Not having a plan is about avoidance and lack of discipline. If you want to avoid these mistakes, you need to work on yourself, on your character, on your ability to handle uncertainty and stay committed to long-term goals even when short-term emotions scream at you. This is why investing is such a powerful teacher. It reveals who you really are, your patience or impatience, your discipline or impulsiveness, your wisdom or foolishness. And if you approach it right, if you use it as a mirror to see yourself clearly, it can help you grow into someone stronger, wiser, more capable in every area of life. The skills you develop managing money, they transfer everywhere. Delayed gratification helps in your career and your health. Emotional control helps in your relationships. Long-term thinking helps in every major decision you make. So don't just focus on avoiding mistakes. Focus on becoming the kind of person who naturally avoids them. Who doesn't need willpower because good habits are automatic? Who doesn't struggle with discipline because they've internalized the values that make discipline easy? That transformation, that growth is worth more than any investment return, because once you become that person, wealth follows naturally. Not just financial wealth, but wealth in every dimension of life.